Hello and welcome to the Plain English Finance Podcast, a podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino. I actually realized I can skip the rest of it because it's in the disclaimer at the end. So, yeah, I am me.
But that was so...
Look at the disclaimer. It wasn't satisfying
It
enough for
wasn't
you.
satisfying. I'm like, keep going. We all know the rest. I'm not allowed to say it, apparently, so I won't. But
No, it's just that they were like, they questioned it. That was all.
okay, so
Now they're going to question this. And,
Yeah.
I'm sorry. And just don't say the word compliance.
yeah, then everyone's okay.
Yeah. Okay, perfect. This episode is the 37th episode. And this one is, you asked me, I don't know if you remember this.
I think I do.
Okay. What is
Is it about interest?
Yes.
I know, because
Look at
I
you
have
go.
been waiting.
I said, you asked me the question. I was like, that sounds like a great podcast episode.
I didn't get an answer. It's been like 2 months.
It's been a while.
And Trey actually just went on another podcast today, and I just found out that I'm not going to get to hear the episode until March. And
Well,
I'm
this
like,
will be out in January time. So people will be like, why are you complaining?
that's true, yeah. Okay, it's like mid-December right now, so 3 months for me to have to wait.
Well, you don't know. It's
And I
my
was-
first guest appearance on a podcast.
Yeah.
So, I mean, when it
So go
comes
check
out.
it out right here. Just kidding.
No, because this is going to be first.
Oh yeah. So also we don't do that little clip thing in the middle. So
I mean, you could, because this part will be on YouTube, but
Oh, right.
unless you're going forwards in time, there's going to be
yes.
no link to it. So
Okay.
I actually have no idea how I'll share it somehow.
Yeah. For
I'm
sure.
interested because it was mainly about, it was more personal than I thought it was going to be.
Yeah. That's what you said, and that's why my interest was immediately piqued. I was like, what did you talk about? What did you say? And he is making me wait till March with the rest of you. So
Yeah, exactly.
take this as your little teaser. Is that what they call it?
Yeah.
I don't know.
It is coming, but
Yeah.
anyway. Okay, so do you remember what the question was?
Okay, I asked what you get back from the markets. Is that called interest? That's how I was questioning it. Is that just like a return? I've heard dividends. I know I have something with dividends.
It's a great question, and it's a question that you always tell me off in knowledge bias.
Yeah.
And it is so true that, I mean, you get to, it feels like the more I learn, the less I feel I know. But you have to also remember that not everybody is as neurotic about this type of stuff.
I like that. No, yeah, I agree. Once you are so into something, you're like, doesn't everybody know this? Maybe not consciously, but you are questioning that, because I do the same thing with all of my knowledge on certain topics that I won't mention right now, but will probably come up later.
Okay, so this podcast is going to stay about finance, okay?
Yeah, okay.
So the question was a great question. Is it interest? There's a few things that you have to understand. And this, honestly, this type of information only becomes valuable to somebody once they do two things. Once they are no longer an employee, or they start investing outside of registered accounts.
Okay.
What do I mean by registered accounts?
Like TFSA, RSP, RESP, RDSP.
Yes, correct. All of those things.
Yeah.
So there are technically more, but I'm going to go with 3 types of income in Canada.
Okay.
You have dividends. That's one type of income.
Yeah.
You have capital gains.
Okay, I've also heard that.
Yep. That's another type of income. And
Yeah.
then everything else.
Nice.
Okay.
Love that, like, miscellaneous category.
Yeah, absolutely. So what is a dividend?
I have no clue off the top of my head. I just
That's
know
fair. Yeah. So
it pays in dividends. I've heard that.
So a dividend is money that a corporation has already paid tax on, and it's giving it to its shareholders.
Okay, say
So
that again,
I
sorry.
own a company.
Mm-hmm.
If the corporation has paid tax on that money already,
Okay.
it gives out a dividend to its shareholders.
Okay.
Okay, so
Yeah.
I'm a company. I make $1 million. You own me as a shareholder. I pay my tax on it. Then the rest gets sent to you, and then you pay your tax on it.
Okay.
That's a dividend. You get dividends from companies in general. And there's two types of dividends, but we won't go into that. So dividends, capital gains. What's a capital gain? You can say I don't know.
I don't know, but I want to take a guess.
Take a guess. Take a stab at it.
It's something about the tax as well. Like you have to pay tax on it still, or the
Yeah,
company
it's a
hasn't
type
paid.
of income.
The company hasn't paid tax on it yet, maybe.
Not quite. So
Okay.
it's the difference between what something is purchased for versus what it's worth when you sell it.
Okay. Yeah. That
So
makes
I
sense.
buy a property, I buy an investment property for $300,000. It goes up.
Mm-hmm.
This is oversimplifying it, but it goes up to $500,000. The difference between what I paid for it, that $300,000, and what I sold it for, $500,000 leaves $200,000.
Of capital gains.
Yes, that's a
Sort
capital
of.
gain.
I know you're saying like this is oversimplified. That's why.
Yes, yeah. I'll come back to that because I'll explain how it's taxed.
Yeah.
And then there's other income. What would be considered other income?
Your job, side hustle.
Literally anything else that
Anything.
doesn't fit into those two categories.
Okay.
Okay, so it includes interest income. What is interest income?
That's the question. Like
Yeah, so what is
I know
interest?
you get interest from the bank if you have a savings account. To
What
like
about how do you pay interest?
loans, mortgage.
Okay, so it's the same thing.
Yeah.
Could you try to define it?
If you're paying it, it's the fee you pay to borrow money. If you're earning it, it's because you're lending money.
Exactly. So it's the cost of using somebody else's money.
Okay.
Or the earnings from somebody using your money. But basically, that's what interest is, whether
Yeah.
you're receiving it or paying it. It's the same thing. So we call that a fixed income type of investment where
Yes. Okay. Yeah.
it's often the fact your downside is limited
Mhm.
and so is your upside. So if I give you $1 million and we have an agreement that you're going to give me 5%,
Mhm.
you're going to give me $50,000 a year, regardless of what you do with that $1 million. And then it's on me as the lender to make sure that you're trustworthy, all of that stuff.
Yeah.
But that is a fixed income arrangement. And there's lots of different types of fixed income, but they, for the most part, they pay interest.
Mhm.
Okay.
Okay.
Same for, and that comes under the other category. Same for a job. You going out and you working a job
You're
is
changing
other income.
time for
Yeah, extra, like your salary or anything like that, even business, like a sole proprietor, this is other income.
Okay. Yeah.
Okay. So the way that they are taxed in Canada, so you'll see tax brackets here brought up. So we can look at the 2026 one because why not? I think this will be coming out in 26. So
Yeah.
So you see there's three categories. So other income, capital gains, and then a big category, Canadian dividends. We'll ignore the two different types. Okay.
Okay.
So what you'll notice in the Canadian tax system that there's tiers. So on the first 54,000, it gives you what the tax rate is. Then tiers after that. So this is for Saskatchewan. Okay. So the higher income you are, the more tax you pay on the income earned in that bracket, not on everything. So often people think that it's on everything, so it doesn't make sense to earn more.
Oh, right. Yes, we've talked about that
But
before.
I would say 99% of the time, you will have more in your pocket by earning more.
Yeah.
Okay. It's just that the higher numbers, you'll be taxed at a higher rate on that income. So above $258,000, you're taxed at 47.5%.
Yep.
Okay, so this is where tax planning comes into place because you want to move income from years where you're in a much higher tax bracket,
Yeah.
moving it into years where you have a lower
Tax bracket.
personal income, right?
Yeah. Yeah.
When it comes to a capital gain, that's taxed. Did you notice something consistent between the capital gain number and the other income number?
It's half.
Yes. So the way that a capital gain is taxed is, so let's go back to our house example, $500,000 house.
Yep.
You bought it for $300,000. That's a $200,000 capital gain. Half of that is free.
Okay.
The rest of it is just added to, for simplicity, other income. So you're taxed on half
Oh,
of the
okay.
gain as regular income. Is
Okay.
an easy way to think about it.
Yep, that makes sense.
Okay.
Yep. Okay.
For a dividend, it's slightly different. So this is where the cool tax stuff comes into place with a corporation. Because remember I said what a dividend is? It's money that has what in a corporation?
Like taxed.
They've
It's
already
been
paid
taxed.
tax on it. Exactly. So it's not fair if that income is taxed at the same rate as your personal income because that hasn't been taxed yet.
Okay.
Okay, so there's something called
Wait, sorry, what hasn't been taxed yet?
So I have two people. One of them owns a corporation and one of them is a sole proprietor, both
Yeah.
plumbing companies, let's say.
Okay.
Sole proprietor earns $100 after profit. They get taxed under other income $100.
Yeah.
If that is within a corporation, if they were taxed on it as $100, so they pay their corporate tax and then they're taxed on it as $100 again under
Then
their
you're paying
personal
so
income,
much.
you're double taxed. There's double taxation.
Yeah.
So there is a principle in our tax code called integration. And that is, it's not perfect, but it's the idea that you shouldn't pay tax twice on money.
Yeah.
So
How
whether
generous.
whether you earn money through a dividend or earn it as a sole proprietor through a salary, it should equal about the same.
Yeah.
And it's relatively good. There are parts when it's not, but overall, you'd say it's pretty good at doing so. So there's two types of dividends, eligible and non-eligible, but we'll focus on the eligible. Okay. So what happens is you get $100 of dividend. It's then grossed up. So on your taxes, it's recorded as if the company hasn't paid tax on it yet.
Yeah.
And then you get a tax credit for what the company would have paid in taxes to try to equal it out. So I have, for simplicity, I'm going to use, these are not true numbers, but I'm going to use them. So let's say there's a 20% tax in a corporation. Mm-hmm. So if I'm taking $100 out of a company,
yep.
On my tax return, it's grossed up to that $120.
Okay.
And they say, okay, this is what we're going to tax you on. This is your taxable income because we need to represent what it would have been if it was in other income.
Yeah.
And then we're going to give you a credit. We're going to reduce your taxes by what the company's already paid.
Okay.
Is the process that it kind of goes through.
Follows. I think I'm following. It's a little murky, but I think I'm following.
That's okay. Do you want me to try illustrate it a different way?
Maybe give one more example.
I have a pad here. I can show you. We're going to say that there's two companies, two people, the sole proprietor and the corporation, and they both earn $100.
Yeah.
Okay. So with the sole proprietor, $100 goes into other income. Okay. And let's say they're taxed at.
Just do the first one.
No, it's way too hard. I need an easy number. I'm going to say 50%.
Nice.
Really high tax rate. Okay. So after taxes, this person that had $100 gets $50 after taxes. Okay. Because they took $50.
Yep.
Government takes $50.
Yep.
Within the corporation, let's say that there is a 20% tax. So at this level, $100 comes into the corporation. Taxman takes $20, which means there's $80 left in the corporation. The corporation then pays out a dividend of $80. Okay.
Okay. Who are they paying that to?
The shareholder, the owner of the company.
Okay.
Okay. So the person gets back $80, and then the government says, if we take 50% of $80, it means that you would be left with $40.
Mm-hmm.
And we've taken how much tax?
20.
Because we took 20% at the corporate level, and we would have taken how much at the personal level as well if the tax rate was 50%.
Oh, wow. Yeah.
If it was 50, so we'd take 50%. So we'd have taken another $40, right? So then the government ends up with how much?
Isn't that everything? Okay, 60. $80, right?
$60. So
total?
Yeah, so the government takes $20 up here.
Okay, yeah.
And then they take another $40 at the personal level.
Okay, yep.
So that means individual is left with $40. Government is left with $60.
The shareholder is left with $40?
Yeah.
So the corporation has earned nothing.
No, the corporation earned $100.
But it's paying its shareholders. I'm sorry.
So
they have no money now.
the corporation has no money. Well, okay, but no, you're trying to equal out once it's gone through corporate or whatever tax structure somebody has. They're trying to equal out the amount of tax that would have been paid.
Yeah, I get that.
So there's no difference. So the corporation earns $100.
Yeah.
The owner of the corporation is now getting paid.
Gotcha.
Okay,
Okay.
so
It's not okay. Sorry. I forgot about the owner being a shareholder too, right?
yeah, they own the company.
They
Yeah,
own the
they're a
company.
shareholder. Yeah.
So if it just depends on how they're structured.
Yeah, so the
that
whole
make
point,
sense? Like-
no, you're confusing me, right? The whole point is that no matter whether somebody was to incorporate and earn money through a corporation
Yeah.
or earn money personally,
Yeah.
there shouldn't be a difference once it gets to your personal hands in the amount of tax that you would have paid, is the point.
That
So
makes sense,
if they don't have integration, this is what would happen. They'd take, let's say it was 20%, they'd take 20% originally, and then they would take another $40
Yeah.
because it's 50%, and you would end up, the individual would end up with $40 and the government would end up with $60. That's not fair.
Right.
So the way that they do it is corporation gets $100 in, CRA takes $20,
Yeah.
$80 is left. When it gets to the personal hands, there's $80 left, but the government says, whoa, 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 we know that you've already paid corporate tax on this.
Mhm.
So we're gonna, on your tax return, we're gonna put $100,
Okay.
and then it's gonna say you owe $50 of that.
Yeah.
So $50 will hit your income as your income tax,
Mhm.
and the government would say, but you've already paid 20, so we'll reduce your taxes by $20.
Okay.
So then they say, okay, well, here's your deduction. So in the end,
30.
you owe $30 on the personal side.
Yeah.
Company's already paid $20. So in this scenario, CRA gets $50.
Yeah.
You get $50.
Yeah.
Which is exactly the same as if you had earned it without a corporation.
Yeah.
That's why when people say, oh, just jump to incorporating without actually thinking about what they're actually doing with their money, it's not always the best scenario. Because while this looks like it's equal, with a corporation, there's a bunch of other costs and expenses and stuff like that. So
Yeah.
you're adding complexity for nothing if all you're doing is bringing the money out anyway to your personal hands.
Right. Gotcha.
The benefit of a corporation is that you don't have to bring it out to yourself personally.
Yeah.
You can leave it in here, only paying that $20, and then go and
Right.
invest the $80.
Gotcha. That makes sense. And then, yeah, you can use other tools to like push the taxes into a different
Yeah, absolutely.
year or like not put it in.
Because I'm using $50 here, but it's not, you saw the tax brackets, it's not 50%. It's
Thank goodness.
depends on the bracket and etc. What do you mean, thank goodness? It's almost 50%. It's ridiculous.
The one I was looking at was like 20 something.
Yeah, but it's on the first, I can print it out, it's on the first.
Well, right now I'm not working. So
Okay. Well, you are. Don't say
guess.
that. Yeah,
Yeah.
there's.
I'm not employed at a job. That's what I'll say.
Yeah, top tax rate is 47.5%. So,
Yeah.
not a fan. Anyway, so that's the way that a dividend is taxed.
Mm-hmm.
Then, difference between an eligible and a non-eligible dividend is it depends on the tax rate that it was taxed at inside of the corporation. Right? I
Okay.
don't know if you remember me saying that the government wants businesses to invest.
Yeah.
They want to encourage businesses to invest, but not every business is equal.
Yeah.
Small businesses are riskier, right? Most people will have, if you're going to have a business, you're going to have a small business. What they do is there are two different tax rates depending on the amount of income and profit in the business. So again, it's not exact, but I'm going to say, for principle's sake, it's $500,000. So the first $500,000 of revenue is taxed at a lower rate than everything else.
Yeah.
So if it's money that's been taxed at a lower rate, it's a non-eligible dividend. So you'll
Okay.
notice that the tax rate is higher.
Yeah. It's just basically the whole idea is listen, everyone should be paying the same amount of taxes. They just decided to really complicate it, it seems. I don't know. Like
It's because there's a lot of other benefits to using a corporation and stuff like that. But
Yeah.
basically, the ultimate goal is that it's reasonably equal.
Yeah.
Often, this is a completely different podcast episode, but often what puts people over the edge when they're deciding whether to take a salary, which is other income, or dividends, which is what we just described, is the fact that CPP isn't included. CPP contributions isn't included in this equation. Okay. So if you're paying a salary, you're paying CPP contributions, whereas with dividends, you are not paying CPP contributions. But when you actually look at the integration, oftentimes you're actually paying more tax, just less overall because of the CPP contributions. Anyway, different episode. We'll get into that at some point. But okay, does that help you understand the differences with the income?
Yes.
Okay, now let's relate this to the stock market, which was your original question.
Yes, I was like...
Answer the question for me.
Yeah.
So, money that you get from the stock market, what is it?
I feel like it could be all three.
Tell me why it would be, each one, tell me why you think it would be.
Capital gains. Sorry, when I take too long, I start overthinking. I'm like, oh my gosh, I'm taking too long to answer. I'm not even thinking of the question or the answer anymore. Okay, and then I'm just gonna.
I'm not gonna save you. So
okay, capital gains is when you buy something and then when you sell it at a higher price, that difference. So if you buy a stock at $3 and then you sell it at $5, that's a capital gain of $2.
Correct, 100%. So capital gains is one, and you've applied it correctly.
Ha!
You said all three though, so.
Oh no.
Dividends or other income, you pick one. Which one you want?
Yeah, I was gonna say dividends. So you are investing in a company.
So you become what?
A shareholder.
Correct.
So if the company has paid the taxes and then gives you, it's like that thing you just showed me, right? Like the piece of paper. So then you're going to get a tax receipt or whatever. Is that how it goes?
So they will give you a dividend, right? So they've made money, they've made profit, they paid the taxes on the profit, and then they're giving you what's left over to the shareholders. That is a dividend.
Yeah.
Okay. So dividends and capital gains, you've applied those both correctly. Don't worry about which one it would be.
Okay. Yeah. Oh, I won't.
Now I want to ask you and make you there, but I'm not going to.
No, I don't.
Okay, so capital gains, dividends. Now tell me how other income could be. Okay, I'll save you.
Yeah, because I'm not sure. I want to say, what if the investment is made a certain way? I don't know.
Are you, again, oversimplifying, are you ever lending money in the stock market?
No.
So you don't get interest.
Wow.
When are you lending money?
Bonds.
Correct.
Yes.
Then you get interest. Yeah. And there's another type of income that you can also get from bonds. Capital gains.
Okay.
And that's dictated by interest rates and things like that, which actually will be a different episode. We'll do that as well. But that's how it works. And how that fits into the bigger picture is because you can see that they're all taxed in different ways, especially when it comes to holding a corporation. The type of investments you hold makes a big difference to the amount of tax that you pay because of the type of income it is. And in a corporation, certain types of income are taxed at a significantly higher rate. Based on this example, could you see why the government would tax them at a significantly higher rate if you've only paid the first layer of tax?
Sorry, which point are we talking about paying?
The higher rate. So the whole point is, remember, to try to make it as even as possible. If this individual gets to the end of everything and they have $50 to invest, and they go buy a 10% GIC, keep it crazy and easy, they get $5 of interest.
Yep.
Let's say next person, how much did they have left over to invest?
80. And
they go buy a 10% GIC, how much interest are they getting?
8.
Right? So because they say, okay, well, this guy only gets 5 and this person would get 8, it's not fair. Therefore, inside of a corporation, types of income, like interest income, are taxed at a very high rate.
Okay.
Okay. And there's certain mechanics that makes it a little bit more complicated, but that's the essence, that it's not fair. So they come in and they tax it at a much higher rate. But there are types of income inside of a corporation that the government does want you to do, so doesn't tax you at a higher rate. Could you think of what type of income that would be on these if you have these three options?
Canadian dividends non-eligible? Eligible?
I put that the whole bracket, just Canadian dividends.
Okay.
Yes, because the government wants to incentivize you investing in even other companies and specifically Canadian companies.
Yeah, that makes sense for the economy.
Yeah. So they don't penalize you for doing the same thing. So when it comes to where do you put investments, that's why it matters. That's why it's something we call asset location, because putting investments, you can have the same portfolio and one is done properly and correctly. So you're optimizing the after-tax consequences, and one of them could be not, and it could be thousands and thousands of dollars of difference due to tax just over the course of somebody's lifetime. So that's why asset location is important. And honestly, when it gets to a certain point of wealth, that becomes more important than even what you're holding.
Right.
You earning an extra, or the potential to earn an extra 1% here or there, isn't as important as you optimizing how you're actually investing.
Yeah.
Which is the difference between what I like. There you go. Next time somebody asks you what I do, instead of being generic, you can tell them that right there is the essence of what I do.
Say it again. Say the line I'm supposed to say.
No, you have to give them the whole whole example, show them
I'm
tax
not.
rates.
I'm not doing that.
No, I'm just saying that
he's a financial planner. Like
a lot of people think that all financial planners are the same,
or they think, oh, at a bank.
Yeah,
Like,
but the understanding of how this integrates and how to do it properly is rare. It's pretty rare when it comes to us, because you have to have such an understanding of the corporate tax side to make it work. And if you never have to, why would you?
yeah,
Like, I mean,
great
90,
question. As I'm like,
yeah, 99+% of Canadians never touch these other things outside of a few times in their life. So
yeah,
if you're a financial planner and you're serving lots of different types of people, it's likely you're not going to get, it's not worth the effort to dive into all this stuff. But yeah, now you have the answer to your question. So
so when I'm
types
like,
of
my
income.
capital gains.
Yeah, I'll be like, okay.
I don't know if that's right though. I'm just gonna be like, how do I know if it's a dividend or a capital gain?
But you could tell by the type of transaction, right? So like a capital gain, this is still oversimplified, thinking of like where this doesn't apply, but simply put, you could say, did I sell a stock? If the answer is no, if that's not how you got the money, then it's probably not a capital gain. If the company gave you money for being a good owner, that's a dividend.
Okay, so, I think, sorry, I'm, when my mind's like working and I can't get it out.
Yeah.
That's what's happening. So you only get the income when you sell.
Not the income, a capital gain.
Yes, but I'm saying, like, if you're looking at your portfolio and my portfolio is at, I don't know, $500,000, you haven't actually taken that money yet.
Correct.
So in your mind, you might be like, oh, I have $500,000. Maybe people don't do that. But you don't actually until you do something about it. You have to sell it, or the company has to.
Kind of, yes. No, you're absolutely on the right track, where a lot of people don't think of the after-tax value of whatever they're holding. Somebody with $1 million in an RSP versus somebody with $1 million in a TFSA, they'll think they're both millionaires. They ain't. They ain't. I would much rather be the guy with the $1 million in the TFSA than an RSP, because I can go spend $1 million. If it's $1 million in an RSP, I still have to pay tax on that. And same principle applies. That's another reason why tax efficiency is so important. So capital gains, you trigger those. I decide when we sell this item. So I have a lot more control over when I take that income, because it's only income. It only hits my tax return when I sell it.
Yeah.
It can grow to whatever. It can sit there for 30, 40, 50 years. As long as I don't sell it, I don't pay tax on what it's grown to. A dividend, though, different. A dividend, as soon as the company pays it, I pay personal tax in the year that is given to me. So
So
I
where
don't
does
have as much control.
where does the money go if a company is paying a dividend? Does it just go into your checking account, or is it in your investment
It's in your investment portfolio.
as cash? Like, would they just give it to you and you would hold it in cash until you buy something else or do something with it?
Yeah, I'll show you. I'm obviously not gonna show the audience. I'll bring up our investments and I'll show you exactly, and then we'll cut this episode because I
It's
don't
a
know.
long one, I think.
Is it?
Oh, I think it says 30 something. 30.
Oh, okay. It's fine.
The audience,
It's like, no.
wrap it up.
Yeah. It's like, hey, we get it.
They're like, oh my gosh, it made sense the first time. Wait.
Oh, markets are down today.
Oh, no.
That's the extent of my reaction, by the way. When markets are down, I don't know whatever they are down. Okay, so if we go to,
I just have to say, I feel like you're loving this conversation. I can just tell you're like excited that I'm
I'm
getting it.
exciting at all different types of conversations.
Wait, what? No, you are excited, not exciting. You're excited that I've got a handle on it, I feel like.
Yeah, you've grasped it well.
Yay.
Does it make you feel happy?
Well, you know, like
'Cause you're gonna
I
forget
will.
it.
Yeah. It's the retention that's the problem. I'm like, oh yeah, I get it. And then a month later, I'm gonna be like, I forget.
Fair enough. Okay, so you'll see here it says
I can't
what is
really
it?
see very
Okay.
well. Just
It says US cash dividend. So this is Nvidia. So it pays out a dividend and that just goes to cash. And Nvidia is so big right now that the dividend is next to nothing. But that would then be either reinvested or can be whatever. But in our portfolio, it will sit in cash for a little bit until I go and personally reinvest it.
okay, but you could set it up as if this dividend gets paid out, put it back
into
in, or do this. Okay.
Yeah, so there's lots of companies that you can do that with. Some you can't, but vast majority you can, and that's where this cash balance here comes from. It's just dividends and distributions and things like that from the investments that get paid out. So when you're looking at tax efficient investing, a lot of that you want to minimize, which is why even you could have, there's so much more to investing as soon as you have to think about this type of thing, because you could have two investments that both earn 10%, but one person gets to keep significantly less after taxes than the other investment. You could even have an investment that earns less than the guy that's earning 10%, but because of the taxes and the way it's taxed, it could end up being different. The person that earned less as a percentage ends up keeping more.
Yeah.
And that's a really hard principle that a lot of advisors don't even understand, let alone individuals, because you have to compare after tax results because it matters significantly more than pre-tax, because you can't spend pre-tax dollars on a boat. Anyway, hopefully that made sense. Hopefully that did that answer your question.
Yep.
You have a good enough knowledge now to be able to determine yourself what type of income it would be.
I'm just probably gonna keep saying. I'm just gonna keep saying interest.
You could say it. And the thing
wrong,
the thing about it is we use different terms for it. I might even say the return or something like that.
Yeah.
And you're talking
return makes sense to me because it's just a blanket, vague statement more than specifically saying.
Absolutely. Yeah. Because even when I say, hey, markets made 15% this year, part of that's capital gains, part of that's dividends, part of it's a whole host of things.
Yeah.
And again, depending on where you keep it, depends on how much you get to keep of that. And I would much rather earn 10% as a capital gain than 10% as a bond, right? As a GIC. And that's something that a lot of people, even with GICs, don't understand, that they might look at the markets and say, well, if let's say it is 5% that the market's getting, and then they're getting 5% on their GIC, they might look and be like, why would I ever put money into the markets? Well, the 5% that I earned, I got to keep 80% of it. The 5% you earned, you got to keep 50% of it. So it's not the same after taxes. And that's the part that matters, is after tax return.
Like, what do I get to spend?
What do I get to spend? Yeah. Absolutely. Okay, anyway, we'll leave it there.
Okay.
The next episode it was going to be on notional accounts and what they are and how that works.
But I'm glad that you said that was what it was going to be about.
You don't want to do that one? It would probably be better that we do that one because you have a basic understanding of dividends.
Okay. Let's do it, everyone. We're
Okay,
doing
we'll
it right
try.
after
We
this.
might
We're doing it back to back.
Yeah, we might pivot, but we'll see.
We'll
Okay.
see.
Anyway, we'll see you guys in the next one.
Bye.
Bye.